The debt problem, I would say very low chance. I keep saying nothing stops this train, which is a reference to the fact that almost anything they do is unlikely to address the fiscal deficit. I mean, this goes back more than a decade. I mean, this is a culmination of multi-decade ago entitlement decisions that were not tuned toward demographic changes and not changed amid demographic changes. The entire war on terror, or the bulk of it, that was rather unproductive and yet expensive. There are various estimates for how much that added to the debt. It's going to continue to add to the debt through interest expense. There's a global financial crisis. We went through a gigantic private debt bubble, and a lot of that debt was kind of indirectly pushed up to the sovereign level. And we ended 40 years of structurally declining interest rates. So we had 40 years of rising debt to GDP, but falling interest rates. And so the interest expense was relatively flat during that time. And that offset is over now. So we no longer have falling interest rates to offset our ever growing debt levels. And so I think these deficits are set to continue into the 2030s with all sorts of ramifications for nominal GDP, inflation levels, things like that. The dollar reserve currency and the trade deficit are two sides of the same coin as far as the system's currently structured. And so if we back up a second, many countries have temporary trade deficits. The US has had like 50 years of continuous trade deficits, so cumulative trade deficits. And I've been highlighting that's an issue for a while. Basically, it results in deindustrialization. So we're basically, indirectly shipping away parts of our manufacturing base to the rest of the world, running trade deficits with them, and then they're recycling it back into our financial assets. So they're buying our treasuries. Nowadays, they more likely buy Mag 7 stocks, but they're basically, we're kind of selling parts of Michigan and other parts of the Rust Belt, and then we're putting it back into New York through the foreign sector. And the reason that they're linked together, the reserve currency status and the trade deficit, is that the whole world, in addition to the normal uses of currency, the dollar has this extra demand component to it that the whole world uses. So they use it for global cross-border contract denomination, which is, not true for most other currencies. They use it for global cross-border financing. So if an entity in Europe lends to an entity in South America, it's often in dollars. Same thing if an entity in Japan lends to an entity in South America or Asia or somewhere, it's often in dollars. And so all of that represents inflexible demand for dollars. There's over 13 trillion in dollar-denominated debt outside of the US to non-banks, over 18 trillion if you include banks. And that's mostly not even owed to the US. That's like owed to other international entities. So it's this big tangled web of structural demand for the dollar. And then it's held as a reserve asset, mainly in the form of treasuries and other securities. And so there's this really big tangled web involved. And the way that the whole world gets the dollars that they need to keep using that is the trade deficit. And the way that works is basically all that extra demand overvalues the dollar on a trade basis, which makes our import power really strong. So we can buy a lot of stuff from the rest of the world. When we go on international vacations, it's fairly cheap for us compared to other countries in the world. So we just kind of spend dollars out there. And the downside is that it makes our low margin exports uncompetitive, even compared to other developed countries like Japan or Germany before they had an energy crisis and other kind of wealthy places. And so one of the issues is if you're trying to tackle the multi-decade trade deficit that the US has, which I think is a good thing to do. I think there's a mandate for it. And I think the imbalances have grown so big that it behooves them to do it. The problem is that that does come with serious trade-offs. If you're trying to reduce the trade deficit, the fact that the trade deficit is what sends the dollars into the world to use as a global reserve currency becomes an issue. And so basically there's a cost to the system as structured. I would kind of question whether or not the U.S. still needs to be the world reserve currency. There's pockets of the U.S. that it benefits. It benefits Washington, D.C. It benefits New York City and a couple other places. Most entities in the U.S. are not really strongly affected by it. If they are affected, they're often negatively affected. And the way that I kind of describe it is that the U.S. as the global reserve currency was set up after World War II, when we were over 40% of GDP. We had by far the biggest manufacturing base, top of the line in every metric. And then, we went through a period of the Bretton Woods system, and then we've now been in 50 years of this current fiat system. And after that long stretch of time, we are 25% of global GDP nominally, 15% of purchasing power parity GDP. So in terms of like physical stuff and kind of physical economy production, we're something like 15%, and we're hollowed out industrially. We're not really big enough to be the only ledger that the entire world uses. The imbalances that are caused by that are massive. And there's no other country that's big enough to be. So China's not big enough, Europe's not big enough, the US is not big enough. And so realistically, the only kind of long-term solution here is to shift toward a more multipolar world, which is that you either have 2 or 3 major regional reserve currencies, and or you have a greater role to play for neutral reserve assets in the system, basically international monies that are unprintable, things like gold or Bitcoin, depending on how far we're looking ahead. As some version of that, the multipolar fiat world and then the neutral reserve asset world is really the only thing big enough to kind of, make global finance run smoothly. Well, I would say partially it's keeping us dishonest because it allows us to have a longer runway to hang ourselves with, which is, so for example, Brazil, the rest of the world got concerned around their fiscal spending, their fiscal deficits. So they sold off the currency. And the funny thing is they weren't running bigger deficits as a share of GDP than the United States was. It's just that there's way less external demand for Brazilian assets that is entrenched in the system than the US. So we're able to run these bigger deficits than we would otherwise. Same thing with back in 2022 when UK ran into the gilt crisis, the trust moment, basically a fiscal issue had them change government because even a developed country didn't have a ton of runway to avoid blunders like that, whereas the US has a lot more runway. And so that allows us to run these bigger deficits, build these bigger imbalances. Japan's an interesting case because one, they have like the most aged demographics in the world. I mean, their average median age is like 10 years older than us or something like that off the top of my head. In addition, part of the way they were able to get as far as they did with all their debt is because on the other side of the coin, they have a structural trade surplus and a current account surplus. They were highly productive for decades. They built up huge sovereign reserves. So they own trillions of dollars of assets around the world, both on the sovereign level and then on their big pension level and individual investor level. And so they have a lot of seed corn to kind of go through as they age. And so I'd say the US and Japan are in pretty different circumstances. I would say what keeps us honest, really, I mean, we have really good rule of law. So the combination of being historically the biggest economy and then having an open economy and then having, all these separation of powers and rule of law and a pretty independent court system, especially when you go through appeals and things like that. International entities feel pretty comfortable here compared to, say, if they own a lot of assets in China, for example. I think over time, multiple of those things are being gradually degraded. So I think we're not as big as we need to be compared to the rest of the world anymore. In addition, even our rule of law, I think, is somewhat being challenged. So I think that document is basically the smartest version of what the current administration is trying to do with trade, which is that is like an academic outline of how they're trying to address the trade balance. So first of all, Myron acknowledges the point I just made, which is that the US being the reserve currency is directly fueling those trade deficits. They go together. And then he proposed various ways to try to rectify that. So one of them is tariffs, but that's only phase one of his plan. In the plan, they weren't really meant to be as big as we've seen. Like they weren't really meant to be shock and awe tariffs. They were meant to be kind of these gradual tariffs, but he's only one voice within the administration. But just taking his paper at face value. So one was set up tariffs, which is then mainly for negotiation purposes, and then perform a Mar-a-Lago Accord. So his paper is not called the Mar-a-Lago Accord, but it proposes a Mar-a-Lago Accord. And the reason it would be called that is historically currency accords are named after the place that they occurred at. So Bretton Woods is named after Bretton Woods, New Hampshire. The Plaza Accord in 1985 is named after the Plaza Hotel, and presumably a currency accord would happen at Mar-a-Lago, and therefore would be, either officially or unofficially referred to as the Mar-a-Lago Accord. That's at least what people call it. I think it's the right term. And basically says after tariffs, you bring everyone to the table and devalue the dollar through a multilateral approach and try to rebalance global trade. It's a well-written paper. It's intelligent. I think it tackles the core issues. He also analyzes risks of his approach. And for example, he has other solutions. Like for example, if you can't get multiple other nations to agree on a multilateral dollar devaluation, he proposes ways to do a unilateral dollar devaluation. In addition, he proposed ways to ironically disincentivize other countries from reinvesting in the US because it's a mechanism to slow down dollar appreciation. And so it's a bunch of kind of controversial topics in a paper. It's well laid out. I think if I were to criticize the paper, I would say that it overestimates US negotiating position. And I would say that we're already in a phase where it's not really going according to the paper. I mentioned before the tariffs are bigger than he would have proposed, I think. And two, if we're going to the next phase of currency negotiation, the US probably doesn't have as strong of a negotiating position as he would have proposed because the dollar didn't strengthen and we had problems with our bond market during the peak of the kind of tariff kerfuffle in the first half of April. And so I think there's still a lot more challenges ahead for having any of that implemented. I think the ramifications will depend on future decisions. I think we're in a very headline-driven market. So every interview I give, I have to give a caveat that everything that I say could be reversed in a day or two, depending on announcements. And there are periods of time where you're not in a headline-driven market. It's more kind of liquidity-driven and process-driven, whereas right now it's a headline-driven market. I don't think it was particularly well done, even though I've said before that I think there is a mandate to address the trade deficit. Then the question is it being well executed? I think the aggressive tactic had kind of the goal of bringing countries to the table. And, it does around the margins. I mean, Europe is kind of, in talks, and you got Zimbabwe to, take away their tariffs and stuff. But in terms of the countries that really are contributing to the trade surplus, they're the ones that haven't budged. And then as the initial period went on, we had US stock markets selling off. And despite that, the safe havens like bonds and the dollar were also selling off. So bond yields were going up while stocks were going down, meaning bond prices were going down. And the Treasury Department under Scott Bessent has a specific mandate to try to lower Treasury yields. That's a self-imposed goal that they have. So that was not really working in their favor. And then the dollar index was falling when it was, according to the plan, supposed to be rising during that period. And then, when they jacked up tariffs to higher levels, the problem is that those are fairly unsustainable for us. I mean, if Americans, went out and found that their iPhones were twice as expensive, that's not great for the economy. That's not great for votes in the midterm. And so, basically then the US had to start rolling back its own tariffs, which is to say that first they said, okay, we're going to do 90-day suspension on the rest of the world except for some of these like lower tariffs. And we're all going to try to focus on China. So we jacked up tariffs to over 100% on China. But then kind of one at a time, we're rolling those back. So it's like, okay, we're excluding phone makers and computer makers. Then we're excluding like auto parts and car makers. Now we have kind of an issue where the biggest corporations are kind of exempt from the worst of the tariffs, whereas a lot of the long tail of smaller businesses that import from China are still affected. And if you kind of outline, is it a good idea to, give big corporations a pass and hurt smaller companies? Most voters and investors would say that's probably not great. So now there's movements to try to roll back the tariffs on the smaller companies, but that would basically be taking back the tariffs unilaterally that we put there in the first place. In addition, I mean, the Asian Financial Group, ASEAN, they had a meeting, I believe, with China, South Korea, and Japan as well. They're three non-members that are large economies that are around the region. And they all basically came out in unity in terms of kind of push back on these tariffs. So the US is currently trying to form a kind of a blockade against China, which is to say, China's the biggest adversary here in terms of excess surpluses. It's hard to take them on directly, but if they can get everyone else on board or like a quorum of other countries, then they'd have a stronger negotiating position. But so far, that's not going through. If anything, China's building a bigger quorum to work with. And so I think that we're kind of in a standstill now. And at the current time, the executive of the Los Angeles port is saying that shipments are down 30%. And if you give that 4 to 8 weeks, that starts showing up on shelves. And so I think that kind of as we enter the summer, we're facing some of the potential downsides of these tariffs. And so far, at least, not a lot to show for them.